Hey guys, this is Mr. Roxy coming at you live from Palm Beach in Florida. It is Sunday. It is July the 3rd. Happy 4th of July to all our American friends. I hope you have a great, safe celebration for the 4th of July. I hope you enjoy the fireworks and all the other festivities that you have planned. And what I try to do is take a little break from what's been keeping me busy and answer the call of one of our friends here at our channel, and very specifically Christopher Olson. It's actually a couple of days ago, he said, I pay for you to do an expose of NGL. And Christopher immediately, after we communicated about NGL, sent me one Maserati. And I thought, hey, you know what? I don't know anything about NGL. Why don't I take a quick dive into NGL Partners, see what's going on? And then you guys can let me know what you think. Is this a buy? Is this a hold? Should we sell, run away? What should we do? Who the heck is NGL? NGL Energy Partners is a limited partnership. Limited partnerships typically are not the type of equities you want to hold in a retirement account because the distributions are taxable, which kind of negates the concept of having equities in a retirement or deferred tax account. NGL engages in transportation, storage, blending, and marketing of crude oil, natural gas liquids, refined products, renewables, and water solutions. Just kidding about the Maserati, by the way. I said I don't do this for money, I do this for fun. So, yep, I don't really have a life, I do this for fun. Let's take a quick snapshot at NGL Energy Partners. You can buy it for $1.51. Now, of course, $1.51, anything that today costs $1.51, which for the typical American is less than the price of a loaf of bread, indicates a cheap price. But sometimes things are priced inexpensively for all the wrong reasons. In the case of NGL, we can see that it's trading at the left side of the grid of its 52-week range, which is $1.33, but it has been as high as almost $3 in the last year. It's a small cap. This oil, gas, and consumable fuels company, it only has a market cap of $200 million. Well, only, right? $200 million, I guess, sounds like a lot of money. Not a lot held by institutions, only 22%, also not a lot short, only 2%. And NGL, along with most of the energy stocks, have been taking a little bit of a dive, as you can see on the chart here. Over the past 6 months, it's been at or around near that high of it a couple of times, but the rest of the time it's just been on a downward trajectory. What do the smart guys say? So the analysts that tip ranks rated a 3 out of 10 is an underperform. So collectively, the analysts do not think that there is much upside to NGL. However, we also need to look at the analysts and kind of take a deeper dive there and see how many analysts are actually covering this equity, and maybe then checking to see how right or wrong they are in terms of their predictions on average. It's nice to see insider buys. $358,000 in stock were acquired over the last 3 months. And as the stock is trading at under $2, that's quite a fistful of shares. Now, unlike the analyst and unlike the technicals and fundamentals of the company, the bloggers are actually bullish. So the sentiment is 60% bullish. And the investor sentiment is also very positive. So, yeah, a little bit of a dichotomy there. Let's look at the analyst price targets. Still with tip ranks here, the analyst price target is $2. However, here's where it gets a little bit tricky. There are no analysts saying buy, there are no analysts saying hold, and there's one analyst saying sell. So we have tip ranks effectively saying it's a moderate sell based on the opinion of one analyst. Now, collectively, the 3,000, more than 3,000 crazy fossil fuel injection burning energy investors we have on this channel for sure collectively are smarter than one analyst who's saying it's a moderate sell. So maybe you can let me know what you think in the comments. For the technical guys, the symmetrical continuation triangle shows two converging trend lines. What is a symmetrical continuation triangle? Well, it's a bullish indicator. The pattern will display two highs touching the upper or descending trend line and two lows touching the lower ascending trend line. This is as of June 28th. So it's just a few days ago, there's a bullish upward trend for the technical guys. And the close price at the time of the event was $1.66. You can see it's dipped a little since then. Does that make it more of a buy or less of a buy? If you're a technical guy, maybe you can tell us. Let's take a few slides here and see what the sort of a deeper dive on the fundamentals tell us. On the fundamentals, because the earnings of NGL are not available, the price to sales and price to book ratios are the most appropriate valuation measures. NGL seems valued at a discount with a price to sales ratio, that's for the trailing 12 months TTM, of 0.02 times, which is significantly lower than the oil, gas, and consumable fuel industry's average right now of about 6 times. However, the price to book is a half, 0.49 times, or 0.5 times in the industry median. The median is 1.54, but the industry right now is at, for the most recent quarter, at 3.79 times. So it looks kind of cheap. Profitability, they're not doing a great job. So on a profitable, although profitable on a gross basis, NGL has inline profitability. So, I mean, if we look at the numbers here, gross profit, they're eking out a profit of about 10%. The industry is doing 34%. So collectively, the industry players in the same segment are doing much better. And then on a net profit basis, the industry is still actually managing to make a little bit of profit while NGL is running negative. They don't pay dividends, so we can ignore this slide entirely. But there are many, many stocks that pay really good dividends in this particular sector. So if you're chasing dividends, you might want to look at one of the others. The annual dividend yield, the industry average is 4.07. So there are some dividend players in the space. Earnings growth at NGL outpaced revenue over the trailing 12 months. It's not sustainable if profits are to continue to grow at this rate. The revenue growth, most recent quarter, 16%, not bad. And the revenue growth for the trailing 12 months, 52%. Pretty good, you know, but still lagging the industry. The industry average is this little black line here, and NGL is the gray blob. So NGL is underperforming the industry and its peers quite significantly. Effectiveness, NGL is doing an overall poor job in comparison to its peers with revenue per employee, return on assets, return on equity, return on investment. Once again, with the exception of revenue per employee, and NGL, when I last looked, they had about 824 employees or so. So from a revenue per employee point of view, they are doing pretty good. We'll take a look at revenue in just a second. Return on equity is horrible, negative 58%. The industry is at least close to 15. How about the financial strength? Now, you guys know I always look at this because it's not that I'm anti-debt. I like using leverage for the right reasons. The thing that irks me the most about debt is consumer debt. And that's mostly related to people who buy things they cannot afford. In other words, you buy the house you cannot afford, which means your mortgage is too high. You buy a car you cannot afford, so you lease it, or you buy it on hire purchase, you pay it off, and you buy a car you cannot afford. If you're taking out debt to buy things, and it's even worse if you're taking out debt to buy the latest iPhone or watch or something like that, that's just kind of stupid. But what you want to do is use leverage to generate more income, or otherwise your efficiency or productivity should increase as a result of your leverage. So if you're a company and you buy a new machine and you are using leverage to buy that new machine, but that machine helps you to improve through automation or robotics or whatever the case might be, your productivity by 20, 30, 40%, arguably, subject to how much the debt is costing you, that could be worthwhile. If you're borrowing money to buy things you cannot afford, that is a terrible idea. The quick ratio for the most recent quarter is just around 1. We like to see 1 or greater than 1. So 1, we're kind of flying too close to the sun here because we're scraping the barrel. It is literally 1.01 for the most recent quarter. The interest coverage is poor at 0.42. So looking at this from a snapshot point of view, the quick ratio is all the current assets versus current liabilities. And comparing the two. Sorry, that's the current ratio. The quick ratio is cash and cash equivalents compared to liabilities that are due within the next 30 days. This is not a good picture, but the good news is at least the quick ratio currently is 1 or slightly above 1. It's okay. How does it compare to its peers? So here are three of its peers. Rattler, I've never heard of that one. Sprague and Summit. I don't know these companies, including the fact that I don't know NGL. Remember, I'm just doing this to earn that one Maserati. The 52-week change is quite interesting here because NGL has taken a 37% dive, along with the negatives on the other two, Sprague and Summit. But look at Rattler, it's up 23%. So, you know, peer-to-peer basis decline market, Rattler is actually up 23%, and it pays a dividend of almost 9, and it has a PE of less than 15. 15, as you will know by now, is my kind of benchmark. I want to be below 15, though. So this is really close. That's a nice dividend. And they have a stock price that's actually on the up in a declining market. Let's take a little deeper dive here. So the big change here is revenue growth. Rattler, despite its good numbers on the previous page and the fact that it pays a very hefty dividend of almost 9%, has very, very poor revenue growth. There it's been outperformed by Sprague at 77, and NGL is not doing too badly either with revenue growth of 52%. Initially, I thought this total revenue, trailing 12 months of almost $8 billion was a typo. So I took a little deeper dive into their income statement. And right here at the top of the page, you can see that the total revenue for the trailing 12 months is 7.9 billion. This number here is in millions, sorry, in thousands. And it gives you a comparison year over year. So it grew from 5.2 to 7.9 billion. That's where you get this revenue growth of 52%. And the cost of revenue, of course, also grew, but there's a huge jump here from 4.8 to 7.4. So the cost of revenue or producing that revenue is growing commensurate with the actual revenue growth. And then the gross profit is up once again. This is sort of in line with what you see in terms of the top line growth. So they're making a lot of money in terms of revenue, but they're not successfully converting that into profit. Growth estimates for NGL, current quarter 94%, next quarter 95% is pretty good, huh? Current year 113%, and then next year negative 148%. I'm not sure how Zacks came up with this number, but that probably requires a bit of a deeper dive. The next 5 years, 3%, that is not interesting to me at all. The next 5 years looks a little bit better at almost 35%. So there you go, NGL. Is this a buy or a hold or a sell? Or is it even interesting? I don't know. Are you guys in the sector? Do you have something else that I didn't mention of either NGL or the three peers that I highlighted briefly? What do you think of the performance of NGL? And is this something that you would actually invest in? Or should we just leave it and run away? You tell me in the comments. I look forward to chatting with you. Take care. Bye.